Welcome to my channel. I'm Scott, and in this video I'm going to walk you through a process of valuing super microcomputer stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 49 billion market cap. They're trading at $8.80 a share, and they have 56 million shares outstanding. Just to explain what the company does on a high level, they are one of the largest producers of high performance and high efficiency servers. They provide service management software and storage systems to various markets, including enterprise data centers, cloud computing, artificial intelligence, 5G, and edge computing. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow is all over the place. Positive 65 million in 2021, negative $500 million in 2022, a nice positive 600 million in 2023, but back to negative in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. That is positive each year, and it grows a lot from 112 million to 730 million. The reason some companies have positive net income and negative free cash flow is because they invest a lot in CapEx. CapEx is investments in property, plant, and equipment, like to buy a factory or machinery. You can see their net income grows a lot year to year. It grew 155% from 21 to 22, 124% from 22 to 23, and 14% from 23 to the trailing 12 months. Their fiscal year ends June 30th, so their 2023 numbers are from 7/1/2022 to 6/30/2023. That means their trailing 12 months is for the calendar year 2023, from 1/1/2023 to 12/31/2023. Revenue is the sales for the company, and that looks really good. It went from 3.6 billion up to 5.2 billion, up 46%. Then it grew to 7.1 billion, up 37%. Then up to 9.3 billion in the trailing 12 months, up 30% from 2023. So their financials look pretty solid. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's 55 billion. We discounted those numbers back to today using weighted average cost of capital. 8.3 is their weighted average cost of capital. We get a value of the company of $44 billion. We divide that by 56 million shares. And we get a calculated stock price of 778. They're trading at 880, so they're trading at a 13% premium. It's a sell according to the model. The way I got their future free cash flow estimates was based off of the company's predictions and also analyst prediction. And it does seem a bit aggressive because they're supposed to break through 3 billion of free cash flow by 2027. A lot higher than prior years. And even if they do that, they do still appear overvalued. There are 35 companies in the same industry as SMCI, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much in CapEx. Most companies in this industry don't spend much in CapEx. Dell spends the most by far. They don't use much debt. They have a really low debt to equity ratio. There's lots of companies at zero with zero debt. They don't pay a dividend. HP pays the highest dividend at 3.8%. Their free cash flow is negative, so it doesn't look so good. Dell is number 1 at over 7 billion. They rank 3rd in market cap. Arista is number 1, then Dell. HP is number 4. They do seem overvalued according to their price multiples. Price to book 13, PE 67, price to sales of 5. And we can't look at their price to free cash flow since they have negative free cash flow. So that should actually be red, not blue. They do generate $9 billion of revenue. Look at Dell, $91 billion. About 15 times Arista, and Arista is bigger in terms of market cap. Why is Arista bigger? Because look at Arista's 5-year annual revenue growth rate, 22%. The market looks towards the future, not the past. And it looks like Dell is plateauing. Their 5-year annual revenue growth rate is only 1%. Supermicro is pretty solid at 20%. Look at Nano Dimension, 70%. That looks really attractive. Let's take a look at their most recent 10Q. This is for the 3 months ending 12/31/2023 compared to 2022. Also the 6 months ending 12/31/2023 compared to 2022. Their revenue has doubled from 1.8 billion to 3.7 billion. Let's see if they give a breakdown of the revenue. Of the 3.7 billion, 3.4 billion is server and storage systems, 229 million subsystems and accessories. Of the 3.7 billion of revenue, 2.6 billion in the US, 650 million in Asia, 288 million in Europe, and 115 million in all other countries. That has gone up in every category except Europe. It's down in Europe. It was 313 million last year. Below revenue is the cost of revenue. These are all the expenses directly tied to generating the revenue. Revenue minus cost of revenue gives you your gross profit. That's 560 million. So their gross margins aren't so great. Their gross profit margin is 15%. That means they convert 15% of their revenue into gross profit. Then they have other expenses like R&D, 109 million. Here's a breakdown of their income statement in percentages. So you can see their gross margin 15%, which is lower than last year of 18.7%. R&D is 3% of their revenue. Sales and marketing 1.3%. G&A 1%. So total operating expenses 5.3% of their revenue. Better than last year of 6.7%. So their operating income is 10% of their revenue. Worse than last year of 12%. And net income is 8%, which is also worse than last year of 9.8%. We'll go back to the regular income statement. Net income 300 million. EPS of 547, that's up from 331. And they are increasing their shares. It went from 53 million to 54 million. On a diluted basis, it's 58 million. So if all convertible securities converted to equity, they would have 58 million shares outstanding. Let's look at their balance sheet. 4.8 billion of current assets, 2 billion of current liabilities. So their current ratio is well above 2. They have 725 million of cash, 1.5 billion of accounts receivables. This is how much money other companies owe them when they sell on credit. They have a lot of inventory, 2.5 billion. Of the 2.5 billion, 1.6 billion is finished goods, 500 million work in process, and 384 million are purchased parts and raw materials. So the first step of the inventory process is raw materials. The second step is work in process, and the final step is finished goods. They have 300 million of PP&E, property, plant, and equipment, and they give a breakdown of that. 140 million of buildings, 138 million of machinery and equipment, 91 million of land, 62 million of building and leasehold improvements, 39 million of furniture and fixtures, 24 million of software. The gross value is 500 million. They depreciated 200 million. So the book value is 297 million. And here's a further breakdown of their PP&E. 184 million is located in the US, 111 million in Asia, and 2.5 million in Europe. They have 218 million of deferred income taxes. These are taxes they'll eventually pay, but they're not due yet. So total assets 5.4 billion, up from 3.7 billion. Total liabilities $2.3 billion. Their biggest liability is accounts payable. This is how much money they owe other companies when they buy on credit. $214 million of accrued liabilities. An accrued liability is when a company incurs an expense but hasn't paid it yet. They give a breakdown of their accrued liabilities. $64 million of accrued payroll, $36 million of customer deposits, contract manufacturers liabilities $25 million, marketing $12 million, accrued warranty expenses $10 million, and operating lease liabilities $9 million. They owe $276 million on the current portion of the long-term debt, and they owe $99 million on the long-term portion of the long-term debt. So you can see that right here, the $276 and the $99. So total debt $376 million. $234 million is a line of credit, $20 million with B of A, $132 million with Cathay Bank, and then they have term loans. They have a $36 million term loan with China Trust Bank. They have a couple term loans with a Taiwanese bank, eSun. And it looks like they have a credit facility with Mega Bank and also a term loan with them. That's another Taiwanese bank. They have $193 million of deferred revenue. Deferred revenue means a customer paid them already, but they haven't delivered the product or service. So it's carried on the balance sheet as a liability until they deliver the product. Then at that point, they book the revenue. Assets minus liabilities equals equity. They have $3.1 billion of equity. They raised $1.2 billion from selling their business, and they profited $1.9 billion from running their business. Let's look at their statement of cash flows. The first section is operating cash flow, and this is for the trailing 6 months. And the way you calculate operating cash flow, you start with your net income, $450 million. Then you add back the non-cash items on the income statement. They had $100 million of stock-based compensation, but they had a big cash outflow in inventory, $1 billion of inventory. So that's why they had negative operating cash flow. They spent so much in inventory, I guess, preparing themselves for 2024. This should create lots of cash inflows in 2024 because they won't have to invest nearly as much in inventory because they spent so much money in the second half of 2023. In their investing section, they spent $17 million of PP&E, last year $21 million. They invested $5.2 million in equity securities. These are investments in other companies. They added $857 million of debt. They paid back $777 million of debt. They received $9.6 million from the exercise of stock options. They paid $41 million of taxes on restricted stock units for their employees. And they issued stock, a lot of stock, $580 million. So that was a cash inflow in this accounting period. So they had $441 million of cash in the beginning of the accounting period, and $726 million at the end of the accounting period. And if you look at their balance sheet, you can see their cash is pretty similar. Cash at the beginning of the accounting period, $440. At the end of the accounting period, $725. Let's look at the stock on Simply Wall Street. Its last price, $881. $49 billion market cap, up 26% in the past week, up 818% in the past year. Let's learn a little more about the company. They develop and manufacture high-performance server and storage solutions based on modular and open architecture in the US, Europe, Asia, and internationally. Their solutions range from complete server storage systems, modular blade servers, blades, workstations, full racks, networking devices, server subsystems, server management software, and security software. They provide application-optimized server solutions, rack mount and blade servers, storage and subsystems and accessories, and server software management solutions, such as Server Management Suite, including Supermicro Server Manager, Supermicro Power Management Software, Supermicro Update Manager, Super Cloud Composer, and Super Doctor 5. It offers server subsystems and accessories comprising server boards, chassis, power supplies, and other accessories. The company provides server and storage system integration, configuration, and software upgrade services, and technical documentation services, and identifies service requirements, creates and executes project plans, and conducts verification testing and technical documentation and training services. They offer help desk and on-site product support services and customer support services, including ongoing maintenance and technical support for its products. The company provides its products to enterprise data centers, cloud computing, AI, and 5G and edge computing markets. They sell their products through direct and indirect sales force, distributors, value-added resellers, system integrators, and OEMs. They are incorporated in '93, headquartered in San Jose, California. Look how low the stock was through 2020. And then it started creeping up a little bit in 2022 and 2023. And then just the past month, it's been like a rocket ship. It went up like 150% in 1 month. Simply Wall Street's valuation is $1,200. They say it's 27% undervalued. 12 analysts priced this stock at $653. Their free cash flow is projected to be $726 million by 2025, $1.5 billion by 2026. They have very little debt on their balance sheet. The highest was $600 million in 2022. But they paid a lot down. It's $375 million currently. But you can see their equity is much, much higher than their debt. Equity of $3 billion. And they have more cash on their balance sheet than debt. The CEO's annual salary is $1. His tenure as CEO is 30 years. And there's been lots of insider buying and selling in the past year. You can see there's more shares that have been sold by insiders than purchased. 68% of the companies held by institutions, 17% by the general public, and 15% by insiders. BlackRock is the biggest shareholder at 11%, then the CEO at close to 10%. A nice steady rise in employees, 1,400 in 2013. 5,100 currently, and the ticker trades on the Nasdaq, Deutsche Börse, Mexican Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.